Welcome to this explainer. Today, we're taking what is basically a chaotic, borderless regulatory landscape and transforming it into a clear, navigable map that you can actually use. Look, whether you're actively building in this space, heavily investing, or honestly just holding a few tokens in a hardware wallet, the rules of the game are shifting rapidly right underneath us. And ignoring them, well, that's just no longer an option.
For a whole decade, crypto basically operated on one rule: no rules. I mean, Bitcoin and other digital assets were running in the ultimate financial Wild West, completely separate from traditional banking. Innovators were moving at lightning speed, while global regulators kind of just sat on the sidelines, watching and trying to figure out what exactly was happening.
But then, the market cap hit this massive milestone, $3 trillion. To put that into perspective, at that scale, crypto wasn't just some niche internet experiment anymore. It was large enough to legitimately impact the global economy. And that forced governments worldwide right off the sidelines. They suddenly had to step in and start writing laws to stop fraud and protect consumers, all while trying not to completely kill the innovation.
So here is our roadmap for today. We're going to cover the regulatory spectrum, look at the US and its regulation by lawsuit approach, check out Europe writing the actual rulebook, hit the emerging hubs in Asia and the Middle East, and finally talk about the rules that hit your wallet.
All right, Section 1, the regulatory spectrum.
So no two countries treat digital assets exactly the same, but broadly speaking, your passport completely dictates your crypto rights based on 4 distinct buckets. You've got countries like China implementing outright bans for capital control. Places like India restrict access by cutting off banks. The vast majority, like the US and the EU, are actively attempting to formally regulate it. And then you have the outliers, like El Salvador, just fully embracing Bitcoin as legal tender.
Now, here's a really crucial point. Regulators honestly do not care if your project claims to be decentralized. They literally don't. They only care about 3 things: stopping money laundering, protecting investors, and maintaining financial stability. If a stablecoin could break a traditional bank, or if an ICO looks exactly like an unregistered stock offering, they are absolutely going to intervene.
Moving on to Section 2, U.S. Regulation by Lawsuit.
Let's look at the United States. It's a market way too big to ignore. But ironically, it's currently operating with absolutely zero comprehensive crypto law. Instead, we're seeing this massive regulatory turf war. On one side, you have the SEC arguing that most tokens are securities, like stocks, which require strict disclosures. On the other side, the CFTC views assets like Bitcoin as commodities, kind of like gold or oil. And this constant tug of war, it creates a massive, super confusing gray area for anyone trying to build legally.
And because there's no modern legislation, the U.S. actually relies on the Howey Test. Get this, it's a legal precedent from a 1946 Supreme Court case about Florida orange groves. Yes, literal orange groves are being used to regulate 21st century blockchain tech. Essentially, if you invest money in a common enterprise and expect a profit based on a dev team's efforts, you might be holding an unregistered security. It's just an incredibly old framework for a brand new technology.
This creates such a bizarre reality for the whole industry. You have these major exchanges getting sued for not having licenses, but there is no actual regulatory path to even obtain one. The US essentially regulates by enforcement, rather than clarity. As a result, major firms are getting hit with legal penalties in the US, while simultaneously fleeing offshore to secure operational licenses in highly welcoming places like Dubai.
Which brings us to Section 3, Europe, writing the rulebook.
In stark contrast to all that chaos in the US, Europe actually sat down and wrote a standardized law. This framework is called MiCA, and it's a huge deal because it provides a single, clear rulebook across 27 different countries. It demands formal white papers for new tokens, strict licenses for service providers, and interestingly, it explicitly bans algorithmic stablecoins. It also caps non-EU stablecoins at 200 million euros a day in transactions, mostly to protect their own currency. Now, when we look at this timeline, we can see a highly structured rollout of global standards. And because of what's known as the Brussels effect, which is where global markets naturally adopt Europe's strict rules just to maintain access to their massive market, MiCA is likely to become the baseline global standard. Between the UK's travel rules in 2023, the EU's MiCA in 2024, and global tax tracking by 2027, large global firms are going to be absolutely forced to adopt these compliance standards everywhere.
All right, Section 4. The hubs, Asia and the Middle East.
So while the US sues everybody and the EU legislates, the Middle East and Asia are just fiercely competing to become the ultimate global crypto hubs. The UAE is aggressively using 0% taxes and dedicated regulatory authorities to attract industry giants. Meanwhile, Singapore actually tightened its rules post-market collapse to focus purely on institutional players, and then you have Hong Kong, which is carefully reopening retail trading to basically act as a highly controlled sandbox for the broader Chinese market.
Speaking of China, it's a fascinating paradox. A country that has heavily banned public crypto trading and mining is simultaneously building massive blockchain infrastructure. They draw a very strict line. They completely reject decentralized cryptocurrencies that they can't control, but they are fully embracing government-controlled blockchain technology and their own digital yuan.
Let's bring it home with Section 5, rules that hit your wallet.
Okay, let's get down to the micro level here. Because even if you're just holding some tokens, these global rules are absolutely going to hit your personal wallet, especially with taxes. Buying a $1 coffee in the US triggers a taxable event, meaning you have to track every single swap. But in Germany, if you hold your crypto for over a year, your tax drops to zero. Over in India, a flat 30% tax essentially crushed local trading volume, and the UAE's 0% policy acts as a massive magnet for global talent.
Beyond taxes, we've got the FAT travel rule. This is a global anti-money laundering standard, and it basically acts a lot like traditional bank wire tracking. Honestly, it's effectively ending the era of privacy on major exchanges. If you move more than $1,000 from a centralized exchange to your personal wallet, regulators are now making sure your name and address travel right alongside that transaction data.
Now, a lot of builders think they're completely safe if they just operate in DeFi. Well, actually, scratch that. Regulators are saying sufficiently decentralized is no longer a legal defense. The underlying code might be autonomous, sure, but if there's a core team holding a multi-sig key, or if they host a website front-end targeting US users, regulators will pull them right back under their jurisdiction. No question about it.
Ultimately, we are heading toward a heavily coordinated future. Regulation isn't disappearing, it's maturing. By 2027, under new global tax reporting standards, the centralized exchange you use will automatically report your crypto holdings directly to your local tax authority. The whole crypto space is being plugged directly into the traditional financial surveillance matrix.
So that whole era of moving fast and breaking things without any legal consequences, yeah, that's officially come to an end. We are transitioning from a world built on permissionless rebellion to a totally new era defined by licensing, identity checks, and structured compliance. The new normal, for sure, is compliant crypto.
So I'm going to leave you with this final thought. As the global regulatory map gets completely redrawn, are you and your investments legally prepared for this new era? Because while the blockchain itself remains a neutral technology, the way you interface with it just became heavily regulated. Thanks for joining me on this explainer. Keep learning, and I'll catch you next time.